In this video, we're going to talk about Accounting Standards Update 2014-09, which has to do with revenue recognition. And there are 5 steps to recognizing revenue according to this standard, but I want to walk you through them using an example so it makes it a little bit easier to understand the information. So let's say in our example that there's a university that has hired your firm to build a new building for them. You're going to be building a building for their Center for the Study of Exciting Things. That's their new building, and your firm has been hired to do this. And so now I'm going to walk through the 5 steps of ASU 2014-09, and that will help us understand the way to recognize revenue. So first step is we identify the contract with the customer. So the customer is the university, and they have hired us to create the Center for the Study of Exciting Things. And of course, we would have an actual contract, ideally specifying everything that we're intended to do. So in that contract, we need to identify the separate performance obligations in the contract. Now that might sound a little confusing, so let's just use an example. So let's say that we're expected to do 3 different performance obligations. And so those obligations are as follows. Number 1 is that we need to design the building. Our firm needs to hire an architect or somebody to actually design the Center for Study of Exciting Things. And then 2 is, after we design the building, we also need to clear the lot. Clear the lot and prepare the lot. That's the area, the lot is the area where we're going to build the building. So now we need to flatten it out. Then we basically need to do a survey to make sure we build in the exact spot we're supposed to build. We also need to make sure that we excavate so we can pour concrete for a foundation. We need to do all the things to get this lot ready so we can put a building there, right? We need to install the electrical, etc. And then the third thing we need to do is the actual construction. We actually need to build the building. So and it doesn't have to be laid out with these 3 things, right? There could be 16 performance obligations. The bottom line is that you need to identify what the separate performance obligations are. And you see in this example there are 3, and they're separate from one another, right? And that's going to become important. You're going to see why in a moment. So now we need to determine the overall transaction price. So let's just say that the overall transaction price is $50 million. So $50 million, that means that to build this building, our firm is going to get $50 million. That's the total price for this entire transaction is $50 million. Now, we need to allocate, and this is why it was important that we identify these separate performance obligations. We need to allocate the transaction price, is $50 million, to the separate performance obligations, to these 3. We need to spread it and say, okay, how much revenue is to be recognized after we've done the design phase, how much has to do with clearing the lot, etc. So let's just say, let's think about this. So let's say that there's 10 million has to do with the design, 10 million has to do with clearing the lot, preparing the lot, and 30 million has to do with the actual construction. I have no idea if those are actual realistic figures, but let's just throw those out there. So now you see that if we add these together, the 10 million plus the 10 million plus the 30 million, that gives us $50 million, which is the total transaction price. So what we've done is we've allocated or spread out this $50 million among the different performance obligations in the contract. And the reason that that's important is because, and this is the final and most important step, we're going to recognize the revenue as each of the performance obligations is satisfied. So once we've done all the designing or whatever it was that we agreed to do in the contract, right? We've specified the performance obligations or the milestones we need to meet, etc. Once we've done everything for the design phase, then we can recognize that $10 million of revenue for the design. And once we've cleared the lot, prepared the lot, did everything there, we can recognize that $10 million. And then once we've constructed the building, we can recognize that $30 million. And so we need to specify these things. So let's just say under this accounting standard, ASU 2014-09, let's say that we didn't specify any of this. We just said, okay, look, you want this building? We will give you this building. And sure, we're supposed to do some of these things. We'll figure out what we need to do. Well, then you might be in a situation where, because you haven't identified the separate performance obligations you're supposed to do, you can't recognize revenue as performance obligations are satisfied. So then you're basically left with what it used to be known as the completed contract method, right? Where you just say, okay, well, once I've built the building and done everything I'm supposed to do, then I can recognize that $50 million all at once. So this accounting standard is very interesting, particularly for construction firms, in that previously a construction firm could just use what's called the percentage of completion method. I mean, they could also use completed contract if they wanted, but they could use percentage of completion and just look at, oh, okay, what percent of the costs have we incurred? And then that would help them determine how much revenue to be recognized. But now, because of this standard, you have to be very clear about what the separate performance obligations are, what it is you're supposed to do, and then how much of the total transaction price is related to each of those obligations, and then you recognize the revenue when you've done that